As we wrap up Whole Life Month here, last week we talked everything you need to know about dividends. This week, we want to make sure that you don't buy the wrong whole life insurance. And so we're going to talk about all the different types of whole life that's available out there and what to look for an optimized design. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and helping you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Vaquero with NetWealth Finance.
All right. Whole life. There's all kinds of whole life out there. Let's start off with a little story on my end demonstrating one of the types of whole life out there that I'm not a very big fan of. Now, my dad is suffering a little bit from dementia, and, I've been selling life insurance for a while now, a number of years, and I found out at some point last year, my dad bought a life insurance policy. Somebody had called him up and sold him a policy, and he had forgot. He had forgot that this is what I do. Obviously, he's not good with his finances these days. Like, he has no control over his bank accounts. I don't know how he was able to purchase this thing. But somebody sold him some final expense life insurance. It's a $2,000 death benefit, and he was having to pay about $50 a month for this thing. He's expecting to live for probably another decade. He would have paid more than $2,000 in just a few years, just in those premium payments. And there's no cash value that grows inside of this policy. And so he's going to continue to kick out this $50 a month to pay for this final expense policy because he wanted to make sure that there was a little bit of something when he passed away. This is not the type of insurance that I generally recommend people buy. Your normal final expense is very expensive, doesn't grow in cash value. It is basically meant for people who don't expect to live very long, and they don't want to have to go through traditional underwriting. It's usually instant approval because it's so expensive. And the life insurance company doesn't need them to live for all that long for them to start making money on it. So, final expense, one of the types of whole life insurance out there, something to be aware of. Most people do not need that and shouldn't get it because it's just not that beneficial from a financial standpoint. I told my dad, and we canceled it. I told my dad, if we just put that money into a savings account, you're going to have more than $2,000 to be able to leave us. Don't worry about it.
That's why when we are talking about whole life insurance, we will tend to want to get a policy with a mutual company, and specifically a participating policy at a mutual company that makes us an owner in that company. And so final expense is one type. On the other end of that spectrum, a properly designed mutual company participating policy. That is what we want to have so we can design it for optimizing cash value for you, and you can earn dividends to grow cash value to become that banking policy.
Okay, before we get too deep in the woods on the type of policy that works great, let's define what is participating and what is non-participating, because this is the other types of whole life that are available out there. Participating means
that you are participating in the dividends that are paid out to that policy. And so it is an important feature. You need those dividends in order to have the cash growth in your policy.
And non-participating means you don't get to participate in whatever the dividends that get announced by that company. Now, there's often some confusion around this because there are companies that you can be a participating whole life policy owner that you're not an owner of the company because you're not buying it from a mutual company. Your large mutual companies, which Carlo mentioned, those are the ones that if you own a whole life policy, you actually become part owner of that company. And when you get to participate in the dividends, you get to participate in all of the profitability of that company and what they announce for the dividends. Whereas some other companies, could be a mutual holding company, it might be a stock company, when they do whole life, they just get to announce a dividend rate. They get to announce what is the amount that whole life policy owners get to participate in. On the flip side, if you don't have a whole life policy, so let's say you bought an IUL or a variable life policy or a universal life policy, you don't get to participate in the dividends of that, even with a mutual company.
When it comes to being a participating policy with a mutual company, the reason we like that is because you are basically a shareholder. You're a policyholder that becomes an owner in that company. And you're not sharing the profits with other people for your policy. So you get paid out. And when you have a non-participating, or when you have a participating policy with a company that is maybe a mutual holding company or a stock company, they have a duty to their shareholders or other people other than just their policyholders.
Yeah, and what we find is that when you become a part owner of, you become a partner with these large mutual companies, you now become a partner with some of the largest, strongest, safest financial companies in the world that have been around for centuries. They've paid out the longest and highest dividends of almost any company out there. And when we're looking to design and build something that's going to be like the financial backbone of our financial portfolio, what better thing to build it on than a company like that? Now, for most of the people that we work with, we're looking at high cash value design policies. And so it's also very important to know whether we're buying into a company that offers direct recognition or non-direct recognition for access to that cash value. But first, let's talk about the design of these policies that grows the cash value, because that's more important than the loan type in my mind.
Yes, and I think the way that I look at this, when we're partnering with a company, we want to partner with a company that has something really good to build upon. And there's really only a few carriers in the whole life space that I would even consider. And what we have access to is some kind of term blend that can minimize those expenses and give us that ability to maximize the funding that is going into those paid up additions. So that tends to be the case. And combined with that, we also want to see strong dividend history with strong controlling of expenses, getting closer to that gross dividend rate that they're paying. So those are some of the factors that I like to think of when we're considering whole life carriers.
Yeah, there's about 5 or 6 really strong whole life carriers that have been paying fairly high or very high dividends for a long, long time. But among those carriers, there's only a couple of them that really stand out depending on the type of design that you're looking to do. Ultimately, when we're looking for really high cash value design, we want high liquidity early on in the policy. We want low expenses so that more of the cash that we're putting into the policy is actually turning into cash that's still liquid and available to us. And it's going to be kicking off at that high dividend rate that these carriers pay out. So we've got about 6 really strong companies. We whittle that down to just about 3 when we're looking at which ones offer the best balance of design for minimal expenses and maximum cash growth, high paying dividends, which helps us with that high internal rate of return, long term, and favorable loan options. Now, I'll also throw in flexibility to adjust how much we're paying in, whether it's a large amount right up front on a dump in, or can we just throw in money throughout the year and we only have a commitment to a small amount.
And when we select between these, we also take into consideration what the person's situation is. Like in my own case, the flexibility was not as much of a concern, but I wanted to be able to fund for a long time. And so there's a particular carrier that I really like for that purpose. And so there's just a lot of variables when selecting the carriers, even among the ones that we do like.
Good points, because on the flip side, a couple of my large policies, I had a very short funding period that I was going to fund aggressively very high and then stop or slow down how much I'm putting in. And so I used a different carrier than what you did that makes it easier to do that with. So we're not necessarily just narrowing it down to one company in every scenario, because it's going to really vary depending on what the client actually needs to do. From a funding standpoint, a large dump-in is going to lead us to a particular carrier. A large dump-in with a low ongoing commitment. You might have somebody that has a high or just a level ongoing commitment. That could be a different carrier. We might have somebody that has a very low intention of funding the entire time. And so if death benefit is the goal of that one, while still growing some type of cash value, that could be a different carrier altogether as well. So there's a lot of variables that go into deciding which one might be best for your particular case.
And that's why it's important to really have a conversation with people who are working in this space. If you're interested in cash value, make sure that the team that you're working with for these high cash value policies knows what they're doing for designing for high cash value.
Now, most of the people we do work with are looking for high cash value designs. And that liquidity, the liquidity that generates is going to get put to use. So when that happens, now we've got to look at what is going to be the best loan type to get, because that might also help us narrow it down again among the different carriers. Of the different loan types, we have direct recognition and non-direct recognition. Define direct recognition for us.
So direct recognition is where the company directly recognizes in some way that you have a loan against your policy. And so they will do some kind of adjustment to the dividend crediting on the amount that those loan funds are against.
Yeah, some carriers will reduce the dividend and completely offset how much you're paying for interest for the loan, while other carriers might give you a reduced credit compared to the loan interest that they're charging you, and it will always be lower than the amount that you're paying. In that case, we're talking about, well, in those two cases that I just mentioned, this is hard to picture in an audio format, but essentially you have what's the equivalent of a wash loan and the equivalent of a small net cost. So you might always have a small net cost when you take a loan. Could be 1%, could be a little bit more than that. Maybe it's a little bit less than that. So that's a direct recognition company. Non-direct recognition gives us some different benefits. What do you get from a non-direct recognition company?
Funds in your policy, when you have a loan against them in a non-direct recognition policy, the carrier doesn't recognize that there's a loan. So it doesn't take that into consideration. The dividend rate for your entire policy will be the same whether you take loans against it or not.
Yeah, and those non-direct recognition loans tend to be a variable rate, and the maximum that they can charge is going to be, from what I've seen, it's typically around 8%. But essentially, it's going to be higher than what your normal fixed rate could be with a direct recognition company.
One of the big risks with a non-direct recognition policy is that when you take a loan, you are going to have a higher rate that you are paying than you are being credited, and it can be a big difference in some cases. There's a popular carrier out there that I think right now is effectually somewhere in the range of a 2% difference, something like 7 or 8% that you're paying in interest compared with being credited around 5. So that's one of the things that can be considered. A lot of folks will say only go with non-direct recognition, but realistically, that's not always the best choice. And there's definitely carriers right now that it is not advantageous to have that non-direct recognition variable rate.
Yeah, there's definitely some risk involved when you're using a non-direct recognition whole life company. That doesn't mean it's not a good decision for practicing infinite banking or borrowing against your policy. It just means that it's going to vary over time whether it's beneficial to take a loan or not in relation to the dividends that you're getting paid out. There are some popular carriers out there that their loan rate is still lower than their dividend rate in a non-direct recognition policy. And there's some really popular ones out there in the infinite banking space where the loan rate is considerably higher than the dividend rate that they're paying out. In general, I don't tend to really prefer non-direct recognition over direct recognition. They're just different, and we don't usually use that as the determining factor on which carrier to choose from. However, if I had to lean towards one, I would probably lean towards direct recognition. So let's talk about direct recognition for a second and why that tends to be my preference. For me personally, I tend to borrow heavily from my policies. Now, I also have a bunch of different types of policies with different types of loans, so I don't necessarily have to borrow from my direct recognition policies. But when I do borrow from the direct recognition policies, I know the loan rate It's a fixed rate. In the ones that I got that I have a very large balance in, it's a fixed rate. I know what it's going to be. It's not going to change from year to year. So from an expense standpoint, because I'm using that cash value to go make other investments, I know what to expect from an expense year to year. If I'm taking that money and I'm buying real estate with it, I know the rate that I'm paying and the amount of money that I bring in from my rents. I know what it has to cover. If I were to use a non-direct recognition with that, and it changes from 5% to 7% in a year, suddenly my expenses could go up by quite a bit, and I might not be prepared for that. That's the type of variability I'm not looking to have generally, especially if I'm borrowing large amounts of money. Now, for some people, that might be secondary. So like I said, this isn't necessarily going to be the determining factor for a lot of people, whether it's direct or non-direct recognition. The reason I tend to prefer the direct recognition is because I can anticipate my expenses better.
And I think one other thing to consider, and I'm sort of actually entering a phase, I think we've had some conversations about this, but even with direct recognition, we do have the ability to collateralize with a bank, and still it can have this sort of behavior like a non-direct recognition in an interest rate environment that is favorable. So we can possibly pay a lower interest rate to a bank that collateralizes our policy and still not have any impact to our policy's dividend. So there's options. And in the event that that goes higher, the rate gets to become unfavorable, well, then you can always just transfer that loan over to the carrier and have that flexibility to lock in those more defined terms in that direct recognition policy.
Good points. That's exactly what I did with my direct recognition policies a few years ago. Rather than take a loan from my carrier and get a reduced dividend, I collateralized with an outside financial institution. I was able to get right around a 3% line of credit against the cash value of my policies, and my 6% dividend didn't get reduced. Now, when the interest rate environment changed and interest rates shot up over 7%, I switched back to the insurance company with my policies. And right now, rates are back down under 6%, and I'm looking to move it back to those financial institutions and away from my insurance company so I can optimize for that dividend again. So you do actually have the ability to have what's the equivalent of a non-direct recognition loan with a direct recognition company if we utilize an outside institution to collateralize it.
That's exactly why, as we said earlier, the most important thing is the strength of the company and whether or not we can get good cash value growth in those policies. And there's variables for whether or not you want to have flexibility versus long-term funding and other factors as well. So it's best to have a conversation because we're not going to have all of the answers for every one of your situations in this episode without having a conversation with you specifically.
So to reiterate, when it comes to making sure that you buy the right whole life insurance for you, we want to identify a strong mutual company that you participate in the dividends, that can be designed with low expenses, very high cash value liquidity early on. That translates into lower commissions to the insurance agent and more cash value in your pocket. And then, of course, are we looking for direct recognition or non-direct recognition? All right. Do you have a call to action for our listeners this week? It's time for this week's call to action.
I think one of the best things to do is to probably get in touch with us. If you're considering whole life, as I'd mentioned earlier, it really takes a conversation to know your specific situation, to know whether or not one of these carriers or one of these products would fit best. So love to hear from you. Book a meeting with us. You should be able to find a link to do that in the description.
Definitely meet up with us if you're looking for things like this. If you're still in the education phase, be sure to hit that subscribe button and stick around, because in the coming weeks, we're going to be breaking down chapter by chapter Becoming Your Own Banker by Nelson Nash, who's the godfather of infinite banking in this whole life insurance space. And really what drew us into getting into this and what gets us so excited about doing this for people every single day. So next week, more on Becoming Your Own Banker. Wrapping up this week, I'm James Barber, your Oregon Cash Flow Pro. I'm licensed for life insurance and annuities across the country, and I look forward to meeting with you guys if you have questions or concerns, and I can help you out in your personal situation.
And I'm Carlo Vaquera. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. We'll work with life insurance clients across the country.
And this is New Year's Eve. We didn't even talk about that. Have a great new year. I hope your New Year's resolutions, your financial ones, have all the success in 2026. We'll see you next year.
Happy New Year.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.